Way of the Turtle: The Secret Methods That Turned Ordinary People into Legendary Traders by Curtis Faith. Book summary in English. Welcome back to Power Books, your go-to source for unlocking powerful knowledge. Today we're diving into a truly groundbreaking story from the world of trading, a real-life experiment that challenged everything we thought we knew about market mastery. Get ready to explore Curtis Faith's incredible account in Way of the Turtle: The Secret Methods That Turned Ordinary People into Legendary Traders. This isn't just another trading book. It's the documented proof that ordinary individuals, with the right system and mindset, can achieve extraordinary results in the markets. We'll break down the core of the turtle trading system, the rules, the discipline, and the crucial psychological shifts that transform novices into consistently profitable traders. If you're aiming for financial freedom and want to develop a disciplined trader's mindset, this is a story you absolutely need to hear. Whether you're already navigating the world of investing and trading, or you're simply fascinated by the power of a well-defined system for achieving success, prepare to gain invaluable insights. We're breaking down Way of the Turtle chapter by chapter, uncovering the lessons that can help you on your own path to wealth building and a powerful trading psychology. Stay locked into Power Books. Subscribe now and hit that notification bell so you never miss our deep dives into the most impactful books on trading psychology, investing, business, self-development, and more, all designed to help you unlock your full potential for success, wealth, and abundance. And Chapter 1, Risk Junkies. In Chapter 1, Risk Junkies, Curtis Faith immediately sets the stage for the audacious Turtle Traders experiment, orchestrated by legendary traders Richard Dennis and William Eckhardt. The chapter opens by highlighting the core philosophical debate between Dennis, who believed trading could be taught through a set of rules, and Eckhardt, who argued that it was an innate talent. To settle this, they famously recruited and trained a group of novices, including Faith himself, providing them with real money to trade using a strict, systematic methodology. The chapter emphasizes the immense psychological pressure inherent in trading. Faith describes the initial attraction of trading, often for those who enjoy the thrill of risk, but quickly pivots to the crucial distinction between mere gambling and disciplined speculation. He introduces the idea that real success doesn't come from being a risk junkie, in the sense of chasing adrenaline, but from embracing calculated risk as an essential part of a disciplined edge. The emotional allure and dangers of untrained risk-taking are contrasted with the rational, detached approach the turtles were taught to adopt. Key takeaways. 1. The nature versus nurture debate. The chapter introduces the central premise of the turtle experiment. Can great traders be made taught rules, or are they born innately talented? 2. Trading's allure and its pitfalls. Trading attracts those drawn to risk, but often this attraction is a junky impulse leading to undisciplined gambling rather than profitable speculation. 3. Calculated risk versus reckless gambling. True trading success requires embracing and managing calculated risk as part of a systematic approach, fundamentally different from the thrill-seeking of a gambler. 4. The need for detachment. The initial narrative hints at the necessity of detaching from the emotional highs and lows that characterize undisciplined trading, a core theme for the turtles. 5. Introduction to systematic trading. The chapter sets the stage for the idea that a set of specific, repeatable rules could be taught to novices to generate consistent trading profits, laying the groundwork for the rest of the book. Chapter 2, Taming the Turtle Mind. Chapter 2, Taming the Turtle Mind, delves immediately into the psychological transformation Richard Dennis and William Eckhardt aim to instill in their turtle traders. Curtis Faith emphasizes that while the turtle system was purely mechanical and rule-based, successfully executing it required immense mental discipline and emotional control. The biggest challenge for the turtles wasn't understanding the rules, but adhering to them rigidly, especially during periods of losses or large profits. The chapter explains that human nature tends to interfere with systematic trading. Fear makes traders hesitate, or exit too early, while greed encourages overtrading or abandoning proven rules. Faith highlights that the turtles were taught to overcome these natural inclinations by completely trusting the system and detaching their emotions from their trades. This meant viewing losses as simply part of a probabilistic game and profits as a result of consistently applying their edge, rather than personal triumphs. The core message is that without taming the mind, even the best system is doomed to fail. Key takeaways. 1. Mindset trumps mechanics. Even with a perfect trading system, success hinges on the trader's mental discipline and ability to consistently execute the rules without emotional interference. 2. Human nature is the enemy. Natural human emotions like fear, greed, hope, and the desire for certainty are major obstacles to disciplined trading and must be actively managed. 3. Trust the system, not feelings. Turtles were trained to trust the statistically proven rules of their system completely, overriding their emotional impulses or gut feelings. 4. Detachment from outcomes. Traders must learn to view individual trades as merely one instance in a long series, detaching from the immediate outcome of any single win or loss. 5. Probabilistic thinking. Embracing a probabilistic mindset, understanding that losses are part of the game and that an edge only works over many trades, is crucial for consistency and resilience. Chapter 3. The first 2 million is the toughest. In Chapter 3, Curtis Faith delves into the unique psychological hurdles faced by the turtle traders as they began to achieve significant profits, particularly emphasizing the difficulty of making the first $2 million. He explains that while the system itself was logical and quantitative, the human element of managing substantial paper profits and the inevitable drawdowns that accompanied them proved to be an enormous mental challenge. Faith recounts how the fear of giving back accumulated gains often became more powerful than the fear of initial losses. This psychological pressure tempted some turtles to deviate from their strict rules by tightening stops too much, taking profits prematurely, or reducing position sizes, thereby undermining the system's effectiveness. The chapter underscores that real trading success isn't just about identifying an edge, but about having the mental fortitude to consistently execute that edge, even when dealing with the emotional weight of large sums of money, both in profit and during periods of inevitable loss. Key takeaways. 1. The psychological weight of scale. As a trader's capital and profits grow, the psychological pressure intensifies. Managing large sums of money, particularly early on, creates new emotional challenges distinct from initial risk-taking. 2. Fear of giving back profits. A common and potent psychological pitfall is the fear of losing accumulated paper profits. This can lead to prematurely cutting winning trades or becoming overly cautious, which degrades the system's long-term edge. 3. Consistency under pressure. The chapter highlights that true trading discipline means adhering rigidly to the system's rules, even when faced with the emotional urge to play it safe or to deviate due to fear of losing current gains. 4. Acceptance of drawdowns. Significant profit growth inevitably comes with substantial drawdowns. Successful traders must internalize this and accept these periods as normal and necessary parts of the probabilistic trading process, rather than reacting to them emotionally. 5. Mental resilience for growth. Scaling one's trading operations requires not just more capital, but a profound increase in mental resilience to tolerate larger nominal losses and volatility, without compromising the systematic approach. Chapter 4. Think like a turtle. In this chapter, Curtis Faith elaborates on the unique mindset that Richard Dennis sought to cultivate in his students. This chapter moves beyond simply following rules to understanding the underlying philosophy that made the turtle system effective. Faith explains that thinking like a turtle meant embracing a probabilistic mindset, understanding that no single trade is guaranteed to win, but that over a large series of trades, a system with a positive edge will generate profits. This mindset required the turtles to detach from the outcome of individual trades, viewing each as just one instance in a long sequence. It also meant accepting losses as a normal and unavoidable part of the process, rather than personal failures. The chapter emphasizes the importance of objectivity and rationality over emotional reactions, encouraging traders to focus on executing their system flawlessly rather than predicting market movements or getting caught up in market noise. Ultimately, to think like a turtle was to adopt a scientific, dispassionate approach to trading, grounded in statistical probabilities rather than gut feelings. Key takeaways. 1. Embrace probabilistic thinking. The core of the turtle mindset is understanding that trading is a game of probabilities. No single trade is certain, but a statistically sound system will profit over many trades. 2. Detachment from individual outcomes. Traders must learn to view each trade as one of many, detaching emotionally from its specific result, win or loss, and focusing on the long-term performance of their system. 3. Losses are part of the business. Accepting that losses are an inherent and necessary component of trading, rather than personal failures, is crucial for maintaining psychological stability and consistency. 4. Focus on process, not prediction. Instead of trying to predict market direction, thinking like a turtle means focusing solely on the disciplined execution of a proven system and managing risk. 5. Objectivity and rationality. Cultivating a dispassionate, objective approach is vital. Emotional responses like fear and greed interfere with rational decision-making and undermine systematic trading. 6. Trust in the edge. The turtles developed unwavering trust in their system's statistical edge, which allowed them to continue trading through inevitable drawdowns and periods of uncertainty. Chapter 5. Trading with an Edge. In Chapter 5, Trading with an Edge, Curtis Faith illuminates the fundamental concept that underpinned the entire turtle experiment: the necessity of having a positive expectancy, or edge, in trading. He explains that an edge isn't about being right every time, but about having a strategy that, over a series of trades, is statistically likely to produce more gains than losses. Faith emphasizes that without a proven edge, all other aspects of trading, money management, psychology, and discipline, are ultimately futile. You're simply gambling. The chapter details how the turtle's edge was derived from a trend-following system designed to capture large market moves. Faith highlights that this edge might only manifest over many trades, meaning individual losses are inevitable and normal. He stresses that once a statistically proven edge is identified, the trader's primary role is to execute it flawlessly and consistently, resisting the urge to deviate based on short-term results or emotional impulses. Understanding and trusting one's edge is portrayed as the bedrock of systematic trading, allowing traders to endure drawdowns and remain in the game long enough for their statistical advantage to play out. Key takeaways. 1. The necessity of an edge. Trading success is entirely dependent on having a statistically proven edge or positive expectancy, a strategy that, over many trades, is likely to generate profits. Without it, you're just gambling. 2. Edge defined by probabilities. An edge doesn't mean winning every trade. It means your strategy has a higher probability of profit, or generates larger profits on wins than losses on losing trades, over a significant sample size. 3. Consistent execution of the edge. Once an edge is identified, the trader's job is to execute the system consistently and without deviation. Any emotional interference or rule breaking undermines the edge's statistical validity. 4. Accepting individual trade outcomes. Understanding your edge allows you to detach from the outcome of any single trade, knowing it's just one data point in a long series where the statistical advantage will eventually manifest. 5. Durability. Through drawdowns. Trusting in a proven edge provides the mental fortitude to endure inevitable drawdowns, understanding they are part of the process for the edge to play out. Chapter 6. Falling off the edge. In Chapter 6, Falling off the edge, Curtis Faith tackles the inevitable and often painful reality of drawdowns and losing streaks that all traders, even those with a strong edge, will experience. This chapter directly confronts the psychological impact of these periods where the market seems to work against the trader and confidence can erode rapidly. Faith emphasizes that even a statistically robust system will go through periods where it appears to fail, leading to significant emotional challenges. He explains that these losing streaks are a normal part of the trading process and are not necessarily a sign that the system's edge has disappeared. The greatest danger during such times is allowing fear, frustration, or self-doubt to creep in, leading a trader to abandon their proven methodology. Faith highlights the importance of unwavering discipline and faith in the system's long-term probabilities, especially when faced with short-term adversity. The chapter serves as a critical warning against reacting emotionally to temporary setbacks and underscores the need for mental resilience to stay on the edge rather than falling off. Key takeaways. 1. Drawdowns are inevitable. Losing streaks and periods of negative returns are a normal and expected part of any trading system, even those with a proven statistical edge. They are not indicators of a broken system. 2. Psychological impact of losses. Significant drawdowns exert immense psychological pressure, testing a trader's confidence, discipline, and belief in their method. 3. Danger of abandoning the system. The biggest risk during a losing streak is succumbing to fear or frustration and abandoning a proven system, which prevents the trader from being in the market when the edge eventually manifests again. 4. Discipline. Through adversity, maintaining strict discipline and continuing to execute the system's rules flawlessly during periods of losses is crucial for long-term success. It requires strong mental fortitude. 5. Trusting the edge. Again, this chapter reinforces the vital importance of deeply trusting the statistical edge of your trading system, even when it feels like it's failing in the short term. Chapter 7. By what measure? In Chapter 7, By what measure? Curtis Faith shifts focus from the psychological challenges to the quantitative methods used to evaluate trading systems and performance. He emphasizes that in systematic trading, simply looking at gross profits or losses isn't enough. Instead, traders need robust statistical measures to truly understand their edge and the inherent risks of their strategy. Faith introduces concepts like expectancy, the average profit or loss per dollar risked, maximum drawdown, and the number of consecutive losses. He explains that understanding these metrics allows traders to objectively assess their system's viability, manage risk effectively, and maintain the psychological fortitude to stick with the system, even during losing periods. By knowing the statistical reality of their edge, for example, the likelihood of a long losing streak, traders can prepare mentally and financially for adverse periods, preventing emotional reactions that lead to rule breaking. This chapter underscores the importance of a rigorous, data-driven approach to trading performance evaluation. Key takeaways. 1. Objective performance metrics are crucial. Relying solely on profit and loss is insufficient. Traders need specific statistical measures like expectancy and drawdown to truly understand their system's performance and inherent risks. 2. Expectancy defines the edge. A system's expectancy, the average return per unit of risk, is the ultimate quantitative measure of its profitability. A positive expectancy is the foundation of a viable trading strategy. 3. Prepare for losing streaks. By calculating metrics like the probability of consecutive losses, traders can mentally and financially prepare for inevitable drawdowns, reducing the likelihood of emotional panic. 4. Risk management. Through data, understanding quantitative measures helps in setting appropriate position sizes and managing overall risk, ensuring survival through adverse market conditions. 5. Reinforcing discipline. Objective data provides a rational basis for maintaining discipline during difficult periods. When you know your system's statistical probabilities, it's easier to trust it even when it's losing in the short term. Chapter 8. Risk and Money Management. In Chapter 8, Risk and Money Management, Curtis Faith reveals one of the most critical components of the turtle trading system: their precise and disciplined approach to capital preservation and risk control. He explains that even with a proven edge, poor money management can quickly lead to ruin. The turtles used a fixed fractional position sizing method, ensuring that they risked only a small, consistent percentage of their total equity on any single trade. This was a crucial defense against large losses during inevitable drawdowns. Faith details how they adjusted their position sizes dynamically based on the volatility of the market being traded and their account equity. This meant they would trade smaller positions in highly volatile markets and larger positions as their account grew, but always maintaining a consistent risk per unit of volatility. The chapter emphasizes that effective money management is not just about avoiding big losses. It's about optimizing growth while ensuring survival. It's the mechanism that allowed the turtles to leverage their edge without risking catastrophic ruin, making it a foundational pillar of their success. Key takeaways: money management is paramount. Even more than finding an edge, disciplined money management is the single most critical factor for long-term survival and success in trading. Poor risk control can destroy a profitable system. 2. Fixed fractional risk. The turtles risked a small, consistent percentage of their account equity on each trade. This ensures that losses are manageable and that they can stay in the game even during long losing streaks. 3. Volatility adjusted sizing. Position sizes were adjusted based on the volatility of the specific market being traded. This ensures that the actual risk per trade remains consistent regardless of price fluctuations. 4. Dynamic position sizing. As account equity grows, position sizes can increase. Conversely, if equity declines, position sizes are reduced. This automatic adjustment prevents over-leveraging during losing periods and scales up during winning ones. 5. Survival first, profit second. The core principle of turtle money management was to ensure survival through adverse periods. By meticulously controlling risk, they ensured they would be around long enough for their edge to play out. Chapter 9. Turtle-Style Building Blocks. In Chapter 9, Turtle-Style Building Blocks, Curtis Faith begins to unpack the actual components of the infamous turtle trading system. He moves from the broad principles of mindset and money management to the specific mechanical rules that the turtles were taught to follow. Faith details how the system was entirely quantitative and objective, leaving no room for subjective interpretation or emotional interference. He introduces key concepts like trend following, entry signals, stop-loss orders, and exit strategies. While not yet revealing the exact rules, those come in a later chapter, he explains the logic behind these building blocks, identifying long-term trends, entering trades systematically when a trend is confirmed, strictly limiting potential losses with protective stops, and exiting positions when a trend reverses or shows signs of exhaustion. This chapter serves as a foundational overview of the systematic framework, emphasizing that the turtles' success was due to a robust, repeatable methodology designed to capture profits from persistent market movements. Key takeaways: 1. Systematic and objective rules. The turtle system was built on a series of precise, quantitative rules that removed subjective judgment and emotional bias from trading decisions. 2. Core components of a trading system. Faith introduces the essential elements of any complete trading system: clear entry rules, defined stop losses for risk control, and systematic exit strategies. 3. Trend following is key. The underlying philosophy of the turtle system was trend following, aiming to identify and capitalize on sustained market movements rather than predicting short-term fluctuations. 4. Risk management integrated into rules. Stop-loss orders were an integral part of the system's design, ensuring that potential losses were always limited and known in advance. 5. No room for discretion. The turtles were trained to execute the rules precisely, without deviation, understanding that consistent application of an edge is paramount to its effectiveness. Chapter 10. Turtle-style trading, step by step. In Chapter 10, Turtle-style trading, step by step, Curtis Faith finally lays out the mechanical, step-by-step application of the Turtle trading system. This chapter reveals the core components that allowed novices to trade systematically with discipline. Faith details the entry rules, specifically using a breakout system like Donchian channels, the precise method for adding to winning positions, pyramiding, and the crucial rules for setting stop-loss orders. He explains the exact calculations for determining position size based on market volatility and overall account equity, ensuring consistent risk per trade. Furthermore, Faith describes the exit strategies designed to capture most of a trend while protecting accumulated profits. The emphasis is on the complete, objective nature of the system, where every decision point is governed by a clear rule, removing discretion and emotional interference. This chapter provides the practical blueprint for how the turtles actually traded, demonstrating the power of a well-defined, executable methodology. Key takeaways. 1. Mechanical system execution. The turtles followed a fully mechanical trading system with precise rules for every decision, removing subjective interpretation. 2. Breakout entries. The primary entry method involved buying or selling short when prices broke out of defined trading ranges, indicating the start of a new trend. 3. Pyramiding into winners. They had specific rules for adding to winning positions as the trend continued, allowing them to capitalize significantly on large moves. 4. Strict stop-loss discipline. Stop-loss orders were an integral part of every trade, calculated to limit potential losses to a predetermined small percentage of capital. 5. Systematic exits. Clear rules dictated when to exit both winning and losing trades, ensuring that profits were captured and losses were cut without emotional hesitation. 6. Position sizing for risk control. Every step was tied back to their money management principles, with position sizes adjusted based on market volatility to maintain consistent risk across all trades. Chapter 11. Lies, Damn Lies, and Backtests. In Chapter 11, Lies, Damn Lies, and Backtests, Curtis Faith addresses the critical topic of evaluating trading systems and the deceptive nature of backtesting. He cautions against the common pitfalls of backtesting, such as over-optimization, tweaking a system's parameters until it perfectly fits historical data, making it useless for future trading, and ignoring transaction costs and slippage. Faith explains that while backtesting is a valuable tool for initial research, it can easily lead to false confidence if not approached with extreme skepticism and rigor. He emphasizes that a truly robust system should perform reasonably well across different markets and time periods, rather than being perfectly optimized for one specific historical data set. The chapter stresses that a system's real-world performance will almost always be worse than its theoretical backtested results due to market realities. Faith's message is a crucial warning. Don't be fooled by impressive historical performance if it wasn't achieved with realistic assumptions. And always remember that past performance is not a guarantee of future results. Key takeaways. 1. Backtesting pitfalls. While useful for research, backtesting is prone to pitfalls like over-optimization, where a system is too specifically tailored to past data and fails in live trading. 2. Realistic assumptions are key. Backtests must incorporate realistic assumptions for transaction costs, commissions, fees, and slippage, the difference between expected and actual execution prices, to be meaningful. 3. Robustness. Over-optimization. A good trading system is robust and performs reasonably well across various markets and time periods, rather than being perfectly optimized for a single historical data set. 4. Future versus past performance. Past performance, even in a well-done backtest, is never a guarantee of future results. Market conditions evolve, and a system's edge can diminish. 5. Skepticism and due diligence. Traders should approach backtested results with a healthy dose of skepticism, understanding their limitations and the potential for misleading interpretations. The real test is live trading. Chapter 12, On Solid Ground. In Chapter 12, On Solid Ground, Curtis Faith transitions from the theoretical aspects of system validation to the practical reality of trading live with a proven, robust system. Having discussed the dangers of misleading backtests, he now focuses on what it feels like to truly trust an edge that has been rigorously tested and is being executed in real time. Faith emphasizes that even a well-built system will experience drawdowns and periods of underperformance, but possessing deep confidence in its statistical edge allows a disciplined trader to persevere through these inevitable rough patches. He explains that being on solid ground means understanding your system's capabilities and limitations so thoroughly that you can stick to your rules without emotional interference, regardless of short-term outcomes. This profound trust frees the trader from second-guessing, constant optimization, or abandoning their strategy at the first sign of trouble. The chapter underlines that unwavering belief in a statistically sound system, coupled with robust money management, creates the mental stability needed to weather market storms and capture long-term profits. Key takeaways. 1. Trust in a proven system. True confidence in trading comes from a rigorously tested and well-understood system that has demonstrated a positive expectancy, not from fleeting market predictions. 2. Mental stability through trust. A deep understanding and trust in your system's edge provide the mental stability needed to navigate inevitable drawdowns and losing streaks without deviating from your rules. 3. Accepting imperfection. No system is perfect, and live trading will always present challenges. Being on solid ground means accepting these imperfections and focusing on consistent execution, rather than seeking unattainable perfection. 4. Long-term perspective. This chapter reinforces the importance of a long-term perspective. A system's edge plays out over many trades, not just a few, requiring patience and sustained discipline. 5. Freedom from emotional interference. By building and trusting a robust system, traders can reduce emotional decision-making, allowing them to trade mechanically and objectively. Chapter 13, Bulletproof Systems. In Chapter 13, Bulletproof Systems, Curtis Faith culminates his discussion on system development by detailing the qualities that make a trading system truly robust and reliable. He emphasizes that a bulletproof system isn't one that never loses, but one that is resilient to market changes, psychologically tolerable for the trader, and has a statistically validated positive edge. Faith explains that such a system is built on sound principles, rigorously tested across diverse market conditions, and includes robust money management rules that ensure survival through inevitable drawdowns. He highlights the importance of keeping systems simple enough to understand and execute consistently, avoiding over-optimization or overly complex rules that can break down in live trading. A bulletproof system provides a clear framework for decision-making, removing discretion and emotional interference. This chapter reinforces that the ultimate goal is to create a system that can reliably extract profits from the market over the long term, not by predicting every move, but by consistently applying a statistically validated edge with unwavering discipline. Key takeaways. 1. Resilience is key. A bulletproof system is designed to withstand diverse market conditions and inevitable periods of underperformance, making it robust and durable. 2. Psychological tolerability. The system must be psychologically manageable for the trader, meaning its drawdowns and losing streaks should be within the trader's emotional capacity to endure, without deviating from the rules. 3. Simplicity. Over-complexity. Overly complex or over-optimized systems are often fragile. A robust system tends to be simpler, easier to understand, and more consistent in live trading. 4. Rigorous testing and validation. Before live trading, a system must be thoroughly tested across varied historical data, not just optimized for a single period, to confirm its statistical edge and robustness. 5. Integrated money management. Effective risk and money management are fundamental components of a bulletproof system, ensuring capital preservation and longevity, even during adverse market conditions. Chapter 14, Mastering Your Demons. In the final core chapter, Mastering Your Demons, Curtis Faith brings the focus squarely back to the psychological battle that every trader faces. He emphasizes that even with the most robust system and diligent money management, ultimate success hinges on a trader's ability to consistently control their internal demons: fear, greed, impatience, arrogance, and the urge to deviate from rules. Faith powerfully argues that trading is, at its core, a journey of self-mastery. He recounts how even experienced turtles sometimes struggled with these emotional impulses, highlighting that the fight is continuous and never truly over. The chapter stresses that understanding one's own psychological weaknesses and developing strategies to mitigate them, like rigidly following rules, maintaining objectivity, and accepting losses, is more crucial than any market insight. Ultimately, mastering your demons serves as a profound reminder that profitable trading is less about conquering the market and more about conquering oneself. Key takeaways. 1. Trading as self-mastery. The greatest challenge in trading isn't understanding the market or even the system, but mastering one's own psychological biases and emotional responses. 2. The constant internal struggle. Emotions like fear, greed, impatience, and overconfidence are perennial threats that can derail even the most disciplined traders, requiring continuous vigilance. 3. Discipline. Over emotion. Adhering strictly to a trading system's rules, especially during periods of stress or strong emotional urges, is the ultimate form of self-control and the key to consistency. 4. Accepting imperfection. Traders must accept their own human fallibility and work to mitigate its impact rather than letting it lead to self-sabotage. 5. The unending battle. The journey of psychological mastery in trading is continuous. It's a battle fought daily, emphasizing the importance of ongoing self-awareness and mental resilience. Bonus chapter, Chapter 15, Epilogue. In the Epilogue, Curtis Faith reflects on the long-term impact and legacy of the turtle trading experiment. He revisits the initial debate between Richard Dennis and William Eckhardt, concluding that while innate talent might play a role, the experiment definitively proved that trading is a learnable skill and that disciplined, systematic execution of a robust edge is paramount. Faith discusses the subsequent careers and varying successes of the original turtles, noting that those who consistently adhered to the core principles and continued to manage their psychology thrived, while others who deviated or stopped trusting the system often struggled. The epilogue emphasizes that the true value of the turtle experiment wasn't just the specific rules, but the profound lessons in risk management, statistical thinking, and emotional discipline. Faith reiterates that human nature, our inherent biases and emotional responses, remains the biggest obstacle to consistent profitability, even with a proven system. He leaves the reader with the powerful message that sustained success in trading is ultimately a journey of self-mastery, requiring continuous vigilance and an unwavering commitment to a rational, data-driven approach. Key takeaways. 1. Trading is a learnable skill. The turtle experiment unequivocally proved that disciplined, successful trading can be taught through a systematic set of rules and principles, rather than being solely an innate talent. 2. Long-term impact of discipline. The epilogue highlights that the varying successes of the turtles post-experiment largely depended on their continued adherence to the psychological and systematic disciplines they learned. 3. Timeless principles. Beyond the specific trading rules, the most enduring lessons from the turtle experiment are the critical importance of robust risk management, probabilistic thinking, and profound emotional control. 4. Human nature remains the challenge. Faith reinforces that even with a proven system, the biggest obstacle to consistent profitability remains the human tendency to succumb to fear, greed, and other emotional biases. 5. Self-mastery is key. The ultimate message is that trading success is a continuous journey of self-mastery, demanding unwavering commitment to rational decision-making, and consistent execution. Chapter 16, Original Turtle Trading Rules. Overview of the rules. The original turtle trading rules are the complete, systematic methodology taught to Richard Dennis's and William Eckhardt's students. These rules are entirely mechanical and objective, designed to remove all discretion and emotional interference from the trading process. They cover every aspect of trading, from what to trade to how to exit. The core of the turtle system is a trend-following strategy designed to capture large moves in commodities and financial futures markets. It relies on breakouts from defined price channels to initiate positions and uses strict money management principles to control risk. Key components of the turtle trading rules. 1. Markets. What to trade. The turtles traded a diversified portfolio of highly liquid futures contracts, including commodities. Example, crude oil, gold, corn, currencies, example, euro, Japanese yen, and financial instruments, example, T-bonds, S&P 500. Diversification across uncorrelated markets was crucial for system robustness. Position sizing the end system, volatility adjusted risk. The turtles used a measure of volatility called N, which is essentially the average true range, or ATR, to standardize risk across different markets. Unit size. They calculated position sizes, number of contracts or shares, such that the potential loss if the stop loss was hit was a fixed percentage, typically 1% of their equity. This meant they traded smaller positions in more volatile markets and larger positions in less volatile ones. Maximum exposure. Strict limits were placed on the total amount of risk in any single market, closely correlated markets, and the overall portfolio to prevent catastrophic losses. 3. Entries. System 1, S1. Short-term system. Enter on a 20-day breakout. Buy if the price breaks above the highest high of the previous 20 days. Sell short if it breaks below the lowest low of the previous 20 days. System 2, S2. Long-term system. Enter on a 55-day breakout. Similar logic to S1, but over a longer period. Turtles used one or both systems. Avoid counter-trend trading. Entries were always in the direction of the new breakout, never against the emerging trend. 4. Adding to a position. Pyramiding. Units. They would add units to their winning positions as the trend continued. A new unit was added every time the price moved a certain increment. Example, 0.5 N, in their favor from the previous entry. Limit. There were strict limits on the total number of units allowed in any single market, typically 4 units. This allowed them to significantly capitalize on strong trends while managing risk. 5. Stop losses. Initial stop. Every trade had a predefined stop loss based on volatility. Example, 2N below the entry price for a long position. This stop was placed immediately after entry. No exceptions. Stops were strictly adhered to. There was no discretion allowed to move stops or give trades more room. This was the ultimate risk control mechanism. 6. Exits. System 1, S1. Exit. Exit long positions if the price moves 10 days below the lowest low of the previous 10 days. Exit short positions if the price moves 10 days above the highest high of the previous 10 days. System 2, S2. Exit. Exit long positions if the price moves 20 days below the lowest low of the previous 20 days. Exit short positions if the price moves 20 days above the highest high of the previous 20 days, allowing profits to run. These trailing stops ensured they held onto winning trades for as long as the trend persisted, only exiting when the trend showed clear signs of reversal. 7. Summary of core principles embedded in rules. Trend following. Capitalize on major market movements. Discipline. Execute rules precisely without deviation. Risk management. Protect capital above all else. Patience. Wait for clear signals and allow trends to develop. Objectivity. Remove emotional bias from all decisions. All right, PowerBooks community, that brings us to the close of another incredibly insightful exploration, this time into the powerful world of Way of the Turtle, the secret methods that turned ordinary people into legendary traders by Curtis Faith. I trust you've gleaned some invaluable insights into the enduring power of systematic trading, the critical role of money management, and the absolute necessity of taming the turtle mind to achieve consistent success. Now, while we've covered the core concepts and astonishing story of the turtles, remember this summary is just the tip of the iceberg. The full book delves into every nuance of their precise trading rules, the psychological challenges they faced in intricate detail, and the deep lessons that can truly transform your approach to the markets. If you're serious about taking your understanding of systematic trading, risk management, and trading psychology to the next level, I highly recommend you experience the complete journey. To help you do that, I've placed a direct link to Way of the Turtle in the description below, so you can easily grab your own copy and continue your powerful learning path. If you found this breakdown illuminating and are eager to delve even deeper, please hit that like button to help us share this knowledge with more individuals striving for success. Don't forget to share this video with your fellow traders and investors. And your thoughts are invaluable, so please comment below with your key takeaways or any aspects of Way of the Turtle that resonated with you. Of course, to continue fueling your journey with more powerful book summaries on self-development, business, investing, trading psychology, and more, make sure you subscribe to PowerBooks and ring that notification bell so you never miss our next deep dive. Remember, here at PowerBooks, we know that knowledge is not power. The application of knowledge is power. So take these insights, apply them to your understanding of the markets, and strive for that powerful edge.